STOT case, and we said there are certain tests to decide whether a receipt is capital or revenue in nature. And we know that if it's capital, it should be excluded from the definition of gross income. And if it's revenue in nature, it will be included. And we looked at the STOT case and we said that we need to determine the intention of the date of acquisition, the period that the asset was held. Now, guys, there's an assumption that the longer you hold the asset before you sell it, then it is actually referred to as investment purposes. And if you don't hold it long, less than 3 years, that's what they say, then it means you can actually be busy with speculation. However, that argument on its own is not relevant enough to conclude whether an amount is capital or revenue in nature. It's very subjective, but we say that is one way. So also consider whether the intention chains upon disposal. Why are you selling this as big profit? Now, guys, if that is the case, then we say, then maybe you are speculating. Yeah? Maybe you are speculating. Is it? So basically, why do you sell? And then there was no proof in this case that the profit, for this court case, there was no proof that it was the profit that actually motivated the sale of the land, and therefore it was capital in nature. We also spoke about the dominant test. Yesterday we looked at the Pick and Pay court case. We also saw that that was capital in nature. Why? Because the employees did not speculate. Speculate means trade in shares. In this case, it meant that they were not buying and selling shares and speculating, okay, if the share price is high, let me sell my shares because then I'm going to make big profits. If it's low, let me keep it, you know, speculating, watching the markets. And that is what was found in this court case. It was actually investment purposes to keep on the long term or long run, and therefore it was capital in nature and obviously excluded from gross income. Then the court versus levy. Here we looked at mixed intentions. We said, maybe I bought it for investment, but now I'm also speculating. So there's a mixed intention. I'm doing both. And then obviously we need to look at the dominant one. Which one is more dominant? And the one that is dominant, either investment or speculation, and that is what we will then have to record. And remember, your own words for capital versus revenue, or the component excluding receipts of a capital nature, the onus rests upon the taxpayer, which is you, whether it is capital or revenue in nature. So they will listen to your own words. We spoke about the ipsi dixi. We looked at the Richmond Estate Court case yesterday, where we said it was found that a company doesn't have a body or soul, or they cannot laugh, and therefore the board of directors actually present them. And we said it's always easy for a juristic person. It's always easy to determine what the intention was, because it will normally be documented. And guys, when I was an auditor, the starting point where we actually, you know, in auditing, you guys are doing auditing now, the planning stage, you know, when we do the planning stage, you need to get an idea, or what they call it is, you need to understand the business entity that you are going to audit. And the starting point, one of the things we did during planning is we looked at the board of directors minutes, because that is where you will find, you know, the expansion projects, capital budgets, and all these things, because this is where you will find that information. So we used to read these minutes. If you don't like reading and you only watch TikTok and Instagram, you will have a problem if you become an auditor, because you have to read long minutes that is sometimes 40, 50 pages long. And to get an idea of what are the type of transactions, what were the intentions of the board of directors for this, for that specific year or that financial year. Then we spoke about the continuity test. Is there a question? Let's quickly listen.
There's a question, sir.
Yes.
Let's say, for instance, a person holds an asset for a longer period of time, but their intention, they were just trying, they haven't been like holding it, but rather they were trying to sell it, but that just they didn't got a customer to buy the asset, for instance. What will that categorize? Will it still be investment?
All right, thank you for your question. It's a very good question. You will see today when we actually go a little bit further into the notes, you will actually realize that we say there was another court case. You know, as a general rule, we say if you hold it for a long time, like you just said, then it will actually be considered investment. But like you just said, maybe I'm holding it for a long time because I don't find a buyer, if that is what I actually understand from your question. Maybe I'm holding it long because I don't find a buyer, but I actually speculate, and that is now basically in your own words that you have to make a case, and then you will probably mention that to say it's not that I actually use or kept this asset for investment purposes. In fact, I'm actually trying to sell it, but I don't get a buyer for it, and therefore it should be revenue in nature. However, that is now basically, I almost want to say, the vice versa of it all. You would actually never, to be honest, guys, you would actually never, as a taxpayer, want something to be revenue in nature. They always opt for capital in nature. Why? Let me tell you why. Because, first of all, it will be excluded from gross income. That means you will already pay less normal tax, isn't it? Income tax. Then, if it is now included in capital gains tax, remember we said sometimes it's excluded from gross income, but there might be other taxes like CGT, capital gains tax. That is a much lower rate. Currently, the CGT, you actually the effective rate is 80% times 20. So for a company, you include 80% of the capital gain, and for a natural person, you include 40% of the capital gain. So, and there's even some rebates for a natural person. You have a 100,000 deduction, annual exclusion, and things like that. So just to wrap up and answering your question is, the courts will listen to what you say, and like you said, maybe then I will have to say that I'm actually not holding this asset for investment purposes. I'm actually trying to sell it, so it should be revenue in nature. But I'm just saying that taxpayers would actually never opt for an amount to be revenue in nature, because that would mean you pay more tax. They would always lean towards capital nature. Did I answer you, sir?
Sir.
Yes, so that category will be like just fall under capital, since even though my intentions was to sell, but I end up not getting a customer. But just because I've been holding for a long time, so it just fall under capital.
Yes, that is what I basically said. There was another question, someone else? Was that? Yes, there was another question just now from someone else.
It was me, sir.
Yes, so speak to us.
All right, so that's why I don't understand about why the onus is on the taxpayer to prove whether an amount is revenue in nature, like in the quiz, because if you're taxpayer, isn't the onus more on you to prove that it's capital in nature?
You are now misunderstanding that whole thingy there. Okay. Remember we said there are certain things certain components that are not defined in the Act. And when we come to capital versus revenue, or excluding receipts of a capital, receipts or accruals of a capital nature, we actually said that it is not defined in the Act. And if it's not defined in the Act, then what SARS is saying is, since they didn't even define it, it would be unfair for them to decide because, you know, the whole capital versus revenue thing can become very subjective, especially in the business realm, because for one person, we interpret things differently. You know, now with the vaccine, even some people and everyone feel like they are actually correct and all these things. So just to come back to you, in fact, revenue and capital is actually, or the whole revenue versus capital is actually not defined in the Act, and it is open for interpretation by the taxpayer. However, to answer you, SARS is always for revenue in nature. So they take a stand. Yes, it's not defined, but they would always argue for that because that means money for them, isn't it? And they also, I believe also the fact that they also have their own targets to actually get enough revenue and all these things. So SARS would always lean towards a revenue nature. So just to answer you there, and that is why in the quiz, that is actually, SARS actually take a stand towards the whole revenue in nature thing. But what I can say is if you want to discuss this more, we can also do that offline in a consultation and all of that. Okay. Now, guys.
All right, thank you.
All right, okay. Let's continue with our lecture because I'm scared we won't finish. Now, guys, today we will look at change in intention. Now, I told you yesterday, people, and this is now just the Namibian examples that I'm thinking of. People have their residential address, their house that they were living in. Then they realize, oh, NUST students coming every year, you know, urbanization. Many of you guys are not from Windhoek, but you stay there now. So then someone saw a business opportunity. And then they decided to convert their homes into student accommodation or whatever the case might be. So there you can see now they've changed the intention. Now the issue is when they now sell those homes, yeah, the house, the question is, should the amount that they receive, because you know with the rent that they get, that is revenue in nature, no issues there, must be included in gross income. The issue comes when they sell that house or that home, that amount that they get, the selling price, should that 1 million or 2 million be included in gross income or not? And we can clearly see that someone's intention changed. Now, what do you need to understand or to remember when there's a change in intention? We say it's important to note that the fact that an asset was sold for a profit, even a considerable, so considerable means even a high profit, a very high one, does not imply that the owner changes his intention in respect of the asset. Now, guys, this is very interesting because remember earlier I told you as a general rule, we say, remember I said that earlier, if you sell your asset for a high, you know, when you dispose your asset, the motive, if you, as a general rule, we say if you sell it because you are going to get a big profit, then it is actually regarded as revenue in nature. However, now with change in intention, I'm saying that that might not always be the case. Okay, so that might not always be the case. So the fact that you sell your asset because someone will are gonna give you a high profit doesn't always have to mean that that is now revenue in nature and that you are busy speculating. So they say it does not imply the owner changes his intention in respect of the asset. So we need to ask certain things. And what do we need to ask? Was the profit the motive for the sale, or did the sale result in a profit? And guys, in the John Bell and Company court case, it was actually established that that something more is required to change the character of an asset. So something more, and basically this thing, what this court case found was that you cannot just say because someone got a high profit that they actually are now busy with speculating. The John Bell court case said that something more is required. You cannot just do that. So in the Stott case, we say an asset may be realized to its best advantage. So guys, Very important. Just because I get a high profit doesn't mean that I'm actually now speculating, because I have the right to realize my asset at its best advantage. So I can look at the markets and I can actually sell my asset at the highest bid or the highest price that is available. And the fact that an asset is sold at a profit or a high profit does not necessarily indicate a change in intention. So that was found. And that's why we say something more is required. And in the yearend farming versus the SPI, they basically found that a mere decision to sell does not mean there was a change in intention. So just because I'm selling my asset now that I'm going to get a lot of money doesn't mean that I've changed my intention. Now, in the CIR versus the NICO court case, there they actually found that this guy sold his company and he sold it lock, stock and barrel. Now, guys, basically what that means is he sold it with the, so it was a retailer shop. So he sold it with the inventory, with the shelves, you know, with everything. That is what lock, stock and barrel. You can put it in Google. You will see you sell it with, you know, with the capital assets and also the revenue assets. And then he claimed that the receipt, the total amount that he got for selling that company, he claimed that it was capital in nature. And then the commissioner held that the sales price was for various company parts, and each would be evaluated as capital or revenue. So basically what the commissioner found was the portion relating to trading stock or trading inventory, that which is floating capital, should be included in gross income. So guys, what they did in that court case is they literally wrote down everything to say this is the shelves. So they had to determine, is this revenue or capital? The inventory, you know, the things on the shelves, is this capital or is it revenue? And so it went on and on. And the commissioner said that it's actually different parts. So that is what they should have done. And the part that related to floating capital should have been included in gross income because that was revenue in nature. And obviously the part that relate to fixed capital, that would be obviously capital in nature and should be excluded from the definition of gross income. So that is what was found in that court case. And then in the Natal Estates Limited versus SIR, we needed, or they actually look at that something more. Remember we said sometimes there's a something more that is required in order for a change in intention. Yes, is there a question?
Can you please go back to the previous slide? Yeah.
Yes. Yeah.
The previous slide, sir.
The previous one, okay. Is this the correct one?
Yes, where it said the portion relating to what? To you said to asset were classified as capital, right?
Yes.
But okay, let's say as a store was sold. Let's say the person who bought it, or are we recording in accordance to the person who sold the store?
I don't quite get you. Remember, this guy sold his company with the inventory, right? But let me, maybe I think I know what you are saying. Let's say he got 10 million total amount for selling this business. What the commissioner said was 1 million is maybe for the stock, 2 million is maybe for the shelves, 2 million, you know, we do a business valuation, and that is one of the things that you will be taught next year in financial accounting, how to value the business so that we actually sell it, business valuations. So that is what the commissioner, but this guy, Nico, he actually said that the whole 10 million that he received was apparently capital in nature. and therefore he didn't want to include it in gross income. And the commissioner said, no. The 10 million is made up of parts, and those parts that relate to floating, to trading stock, should be included in gross income, and the rest will be included in or will be as capital nature, which should be excluded from gross income. Did I get your question? Was that your question?
Oh, yes, sir. Thank you.
All right. Okay, let's continue.
Okay,
so
let's
yes.
say, sir,
Yes.
let's say if that when he before he sold his company, he used to those assets. Let's say he used those assets as inventories.
Yes.
Like, yeah.
Remember the tree and fruit principle. With, I know I've used the block of flats, where we know the block of flats, the building is capital, right? And the rent is revenue. But in a shop, guys, in a shop, as a retailer, you will also have capital assets and you will have revenue assets. Revenue assets, inventory floating, that is the stock, isn't it? What you are selling, yeah, that's revenue. But your shelves, that is capital asset, isn't it? The motor vehicle that, the cars and those things that bring the inventory there, trucks, whatever you have, those are your capital assets. The issue comes so over the years when you were trading, it was quite easy because you know which one were capital assets. And remember, you would have even claimed you would have even claimed depreciation. Remember, in tax, we don't call it depreciation, we call it wear and tear. But for tax, you could have even claimed wear and tear on the capital assets, okay, over the years. The issue comes when you sell. When you sell this business. Now, and in this case, he sold it with the assets and the inventory, everything, and he didn't want to include the amount in gross income. He said the whole amount, and that doesn't make sense. He said the whole amount actually is capital in nature, and the SARS basically said, no. Some of these things relate to revenue, others relate to capital in nature. Is that fine now?
Yes, thank you, sir. Get it.
All right. So yes, yes. Let's hear from you. Go ahead.
The stock will now be valued at the selling price or at the order price.
All right, that's a very good question. Remember, in financial accounting, we look at NRV, right? Net realizable value. Same principles here. We also apply the same principles. But guys, that is irrelevant in this case. Is someone did the business valuation, and someone told Mr. Nico that his business is, let's say, 10 million. And I don't know what the amount was, but he got 10 million. So in this case, what method they use to value the inventory and what methods they use to value the capital. In this court case, that was irrelevant. It is just that SARS basically said this actually relate to different parts to answer Nobukoshi, and that is that a certain part of the 10 million relate to inventory, and you can even go deeper to see, okay, how did they actually value this inventory and things like that. But at the end of the day, it was just that the 10 million was not capital in nature as a whole. Some of it was revenue in nature and some was not revenue in nature. But to answer you, we also use the same valuation methods in tax, where we look at NRV and all those things when we include amounts in gross income. And next year in Namibian tax, you will see that there's even a whole chapter on trading stock or trading inventory that we will discuss, because they are different. The rules is a little bit different from a financial accounting perspective. Due to the fact that we say something should have been actually incurred. But don't overthink that now. Just know that we use the same valuation methods. But guys, for the sake of time, let's continue. let's look at the Natal Estates Limited court case where that something more was now determined in order for there to be a change in intention. So the property in Natal was acquired initially for the purpose to farm with sugar cane. So it was capital, of course, initially. And then the method in which the property was sold suggested that there was a change in intention, because guys, what they did was now they've subdivided the farm, you know, they've actually now used fencing and they've made it now into small little plots, and that is how they sold this farm. So the commissioner now said that this is now not capital in nature anymore. It seems like you are now changing your intention change. You are crossing the Rubicon. That is basically it just means you've changed your intention. You don't now keep the property anymore just for investment purposes. In fact, the way you are selling this property now indicates that you are actually dealing in selling, you know, farms or sugarcane properties, and that was the issue in this court case. So the activities of the company converted its fixed assets into trading stock. So you had one fixed asset, which was the property, and now you've subdivided it into what they decided that it is now trading stock, because you are now selling these little plots. So examples of something more was the subdivision, also the way they marketed, you know, they really went on an intensive marketing spree to market these subdivided plots, and therefore it was found that the owner in the Natal Estates court case actually crossed the Rubicon. Cross the Rubicon just means you have changed your intention, and therefore the property became stock, and we say the income will be included in gross income. So selling those subdivided plots, the income that he received or that Natal Estates received should now be included in gross income, as it is revenue in nature. However, if they probably didn't subdivide that, you know, the farm, the initial sugarcane farm, and if they sold it as a once-off transaction, got 10 million, then that would have probably been capital in nature. However, since the subdivision marketing, it was found that he crossed the Rubicon. Now, guys, another share transaction in the NUST court case, it was found that the profit on share transactions can be taxable in gross income if the frequency or volume, so this is another court case, frequency or volume of the share transaction suggests the carrying on of a business. Now, guys, in South Africa, it's a different story as compared with Namibia. In South Africa, you literally have share traders, people that trade in shares. They buy shares, they sell shares, they do that for a living. They are a share trader. In such a case, like this court case, it was found that this is actually carrying on a business, and therefore that would actually be a revenue transaction, and the profits or the money that you receive, the proceeds that you receive, should be included in your gross income. The primary intention could be the holding of shares for long-term dividend income, but your secondary purpose of selling at a profit in the future could actually now taint the primary purpose and result in a change in intention. So here, guys, in this one, it was interesting because remember earlier we said that me selling my asset at its best advantage, doesn't necessarily mean that I've changed my intention. However, in this court case, in the Nico court case, and especially in the Natal court case, we saw that you've actually changed your intention. And here in this share, or in the NUST court case, we also say that here you've also actually changed your intention. Initially, you bought it to actually hold it long term, so it was investment purposes. However, later on, it seemed like you have now tainted. You've changed your primary purpose, and that is why it's so important that your own wording will be listened to, and then a decision will be made. In the Berea West Estates court case, and here we looked at a realization company. Now, guys, that is also one business opportunity, especially in the property market. Sometimes they create these realization companies. Okay, now using a realization company to realize a capital asset merely means the taxpayer is disposing of the asset to its best advantage. Now, guys, this is now again different. You see here it was revenue in nature when they changed, and in this case we are now even saying again, if I create a realization company, guys, let me just give you background. In a group of companies, next year in financial accounting you will do consolidation, group of companies. Sometimes you have a parent company and then they have subsidiaries and associates and all these underneath them. So parent being you are the parent, you are the holding company. So guys, what I've seen when I was still in auditing, sometimes they create a specific company that will just receive rental income from the rest of the group. Okay. And this company's main purpose is just to receive rental income. Now in South Africa, there's another type called a realization company where people create a company where they actually put this property in and then they just sell this company. Because guys, there are two ways to sell, or there are many ways to sell a property. The one way is you sell it and you have to include it, or you have to pay capital gains tax. Another way is I create a company and then I'm just selling the shares in that company, because remember that property would automatically belong to the company, isn't it? But there is now share capital. So then I'm just selling the shares, and that is where these realization companies come in. And guys, a lot of people actually prefer them to actually just sell, because it also takes a shorter time to actually sell a property like that. In the sense that, let me just give you an example, and I'm now speaking, I'm now not being very confidential, but let me just give you a Namibian scenario. I know many of you guys are going to the Brewers Market. Now the Brewers Market, or the warehouse as it used to be called, that is a property of the O&L Group, and the Old Harbour and List Group, which is the parent company. Now a few years ago, so O&L, that is the group, but the holding company is the O&L Group, and then under them they have Namibia Dairies, they have Pick n Pay, they have Alexander Forbes, and they have even these Brewers Market and all, even Namibia Breweries Limited, NBL. So all these are actually subsidiaries. Even the Midgard Lodge and different collection of lodges also fall under the O&L Group. So it's a very good example of a group of companies, that one. So NBL needed property, okay? But you know, in Namibia, it can take very long to transfer property into your name. So you know what they did was, they decided, okay, let's actually, oh, did I actually, I forgot the facts now. Oh yeah, they needed property, yes, and they bought that property from one of the other group members, one of the other subsidiaries. So what they did, since they all belong to the same group, they converted that property. They created a company, transferred all the shares in that company, but that company now only own a property. So what they did was they basically decided not to buy the property, but to buy the company, the shares in the company, 100% shares in that company. And that meant that it was a much faster transaction. So it took 2 weeks and the property actually belonged to NBL. However, if they bought the property, it would have probably taken 8 weeks because you need to go to the city of Windhoek and you need to pay bond fees and registration and all these things. So it's a very lengthy process. However, if you buy the shares, much easier and so forth. Guys, that is irrelevant here. I just needed to give you an idea of what realization companies do. Now, we say if you create a realization company, that was found in the Berea West Estate court case. If you create a realization company and you dispose your asset to its best advantage, then that would not mean that you are now speculating. So that would not be revenue in nature. The receipts of the realization company are in fact capital in nature. It doesn't necessarily indicate a change in intention. Another one in the founders yield court case, there's to be a real justification for a realization company to be formed. Now, guys, you are not busy stealing from the government. These are all options, and this is where us, you and me, if you are a tax expert, this is where we come in and we give our customers, our clients, the best advice, how they can legally manage their tax burden. So remember, we spoke a little bit about tax avoidance and tax evasion. Remember, tax avoidance is legal. You are using, I almost want to say you are using the act against the government so that your tax burden become less. And that is legal because you are using the options available to you. A realization company was one which was formed to facilitate the realization of property which could not otherwise be dealt with satisfactorily in this court case, and it could thus indicate a change in intention. Now, guys, just now in the Berea West Estate, it was found capital in nature. In the founders yield, there it was now a revenue transaction again because it was actually found, and you obviously have to look at all the facts of that. Is why, guys, I think if there's one thing that you've learned today is one fact alone is not enough. We need something more. We need to look at the whole picture holistically. One criteria on its own is not enough. And that brings me to the disposal of long-term investments. In the CIR versus Nel court case, the taxpayer purchased Kruger rands. Now, guys, rands is a big thing in South Africa. People actually collect Kruger rands. If you actually have Kruger rands, you can actually be, you are actually a rich person. You can read up on Kruger rands in South Africa. It's a gold rand with Mr. Kruger, I think that was his name, face and all of this. The reason why people collected these rands, and if you sell it now, let's say you bought it for 10 rand, and then in the future it might be 20 rand, then it means you make a profit of 10 rand, isn't it? So Kruger rands is actually a thing in South Africa. So obviously Mr. Nel's intention was to hold these Kruger rands as long-term investments. However, later he was actually forced to sell. Now, guys, this already indicates to me forced to sell as he needed cash to buy his wife a car. And then they actually found that his intention hadn't changed. It was still an investment. The purpose of the sale wasn't to make a profit, but to realize a capital asset in order to purchase another capital asset. So you see, here is a capital asset. Intention was to hold it as long-term investment. Now he actually had to sell his car because maybe he didn't have other options to raise this money, and this wife want a car. You know how they can get difficult. Okay, in our case it is, they need hair. But anyway, so he needed the money, so he sold his Kruger rands, and obviously what was found in this case is that he actually didn't change his intention. He just realized his asset to the best of its advantage, and the proceeds was therefore capital in nature. capital in nature. Damages and compensation in the WJ for rebeleggings court case, the compensation for damages capital assets was obviously capital in nature, and the compensation for loss of profit or income was revenue in nature. And we needed to look at other damages paid to fill a hole in the profits of a taxpayer or of his capital assets. Now, guys, this one is very important when it comes to insurance payouts. Okay, remember when you insure your inventory, your stock. If you insure your stock, then, and let's say there's a flood, you know you will get a payout from your insurance company. Now that payout, that is revenue in nature. You have to include it in your gross income. So you see revenue in nature. Compensation for cancellation of a contract in the Stellenbosch Farmers Winery versus Commissioner of SARS. Here it was found that the compensation for cancellation of a contract to an income earning right will be considered capital in nature. You know, guys, sometimes we enter into contracts, long-term contracts, and we say, if I now need to cancel it prematurely and I need to pay out, or I get a payout. Remember, if you are in breach of contract, you might have to pay out someone that money. Now, the money that they received, the Stellenbosch Farmers Winery, it was found to be capital in nature. Now, guys, remember the onus of proof for non-taxability lies with the taxpayer, section 82. Now, guys, here we have some subjective factors that the courts will look at, and they are the ipsy-dixy commercial activities, basically what the taxpayers say, but some of objective, because, guys, intention can be very subjective. What you say is just your words. It can be very subjective. However, some of the objective court factors that we can look at is how long did you hold this asset? Once again, I need to emphasize that one of these things alone is not conclusive evidence to say that it is now capital in nature or not. Okay? So normally, if you hold it for a long time, we say that is capital in nature. You've actually kept it for investment purposes. Frequency of such transactions. Okay, so if you are doing very often of these transactions, then we say that would be revenue in nature. If it's infrequent, it will be capital in nature. Nature of a taxpayer's business. If I'm a teacher and I'm selling my house, then you cannot really say that I am now speculating, because you see my business, the nature of my business is I am teaching. I'm a teacher. Okay, then income stream, reason for selling, finance. Now, guys, funny enough, in South Africa, they believe that if you take a bank loan, apparently that would be revenue in nature. If you don't take a bank loan, that would be capital in nature. If you now use your own money and all of that, that is a lie in Namibia, because most of us anyway have to take out a bank loan to buy a house to stay in. That is how expensive property is in Namibia. So me taking out a loan doesn't mean I am speculating. However, in South Africa, property is much cheaper, so that is the assumption. Apparently, if you take out a loan, then that would be seen as revenue in nature. However, on that property, of course, or that capital asset that you are now selling. And then the nature of the asset trading versus fixed assets, you know, floating versus fixed. Then business sale. Now we say the selling price is allocated to the assets sold. Damages and compensation, payment for the loss of the capital asset versus the loss of the profits. So you see capital assets, capital in nature, profits, revenue in nature. For fortunes gains, here we look at gifts, prizes, donations. We say as a general rule, it will be capital in nature unless it is used in a scheme of profit making. Then gambling, I think someone asked yesterday, bad way and these things. Generally, gambling would be capital in nature. unless that person is a professional gambler. Now, guys, interesting enough, in South Africa, you literally get professional gamblers. And also, guys, we need to ask you, to the student who asked that question yesterday, if you are doing this gambling now very frequently, on a regular, then maybe you are becoming a professional gambler. Then goodwill generally, that is capital in nature. Illegal business, remember we spoke about the legality, and we said the legality is irrelevant in the question of the liability of the Income Tax Act. And then interest and rental, the fruit, of course, is the amount of money that we receive for revenue. And interest, that is also fruit. That is also fruit that need to be included. Fixed property, obviously capital in nature. Krugerrands, also capital in nature. Loans, we spoke about loans. We said that a loan is actually, you don't include it in gross income because you have to repay it. So you don't even include it in your gross income. Realization companies, I spoke about that earlier. Restraint of trade payments, guys. We say it is capital in nature, but it must be included in gross income in terms of paragraph CA of the gross income definition, which is special inclusions. That is what we will be looking at on Thursday. And then the rights and options. Now, guys, these rights and options are referring to share rights and share options. It depends on the intention when the rights and options were acquired, and not when it is actually exercised. Now we are done with the excluding receipts of a capital nature. Now we will look at source versus deemed source. Now, guys, remember, for a resident, you are paying tax on your worldwide income. For a non-resident, you are paying tax on a South African source or a deemed South African source. And very important, source is not defined once again in the Act, so we have to look at court cases. Deemed source is defined in Section 9. Guys, South Africa is so intense that they say if that thing doesn't look like a source, then if it just slightly look like a South African source, it will be regarded as a deemed South African source, and therefore you will have to include it in gross income. Now, guys, the introduction to the gross income definition, we've done that now in chapter 2 and in chapter 3, which is our next chapter on Thursday. Not so long. That one is definitely not this long. We will look at special inclusions. The references that I've used is the University of Johannesburg and also your prescribed textbook. I've looked at the SARS website, and I've also looked at the Integrated Tax Administrative System, which is Namibia's ITAS website. And this is where I got my information. We are finally done with this chapter. You are fully equipped to answer your case study, because